Good afternoon, everybody. Uneducated Economist here. Thought I'd talk about gold and silver and bonds, and because something I got to thinking about. I've always been under the impression that it was bond investors versus gold investors. Bond investors would look at the gold investors and say, "You got a dumb asset, doesn't pay an interest. You're just looking to sell it to the greater fool." The gold investors will look at the bond investors and say, "Yeah, you're tying your money up into a devaluing dollar. Inflation concerns will erode your purchasing power. Why would you want to tie your money up for 30 years?" So that was kind of always the argument back and forth. As interest rates really started to come down, bond investors turned from being investors to speculators. And I kind of said that back, throughout quite a few videos, and even throughout the years, I've said that bond investors used to argue with the gold investors saying that you have a dumb asset that doesn't pay an interest. Well, bonds don't pay an interest any longer. The yields on them have dropped so low that the only reason why bond investors even buy bonds is because they're anticipating that the yields are going to drop into the future and they'd be able to sell those bonds for a profit. So the bond investor has become the speculative buyer of bonds, just like the gold investor would buy gold. They worked in lockstep together, if you noticed. As the yields were dropping on the bonds, in the anticipation of inflation coming into the future from all this money printing, had people buying gold. So as the bond investor was buying bonds, thinking that the Federal Reserve is going to be printing up a bunch of money and buying bonds, they would be able to front run the Fed by doing this and selling those bonds to the Fed for a profit. That same perception about injecting all this money into the economy had also had the investors buying gold. So gold and bonds were rising together. Now, a few weeks ago, I'm on George Gammon's show, and he's asking me, he's saying, "Hey, man, what do you invest in?" And I'm like, "Man, I don't invest. I'm not an investor. I save. I save in gold, I save in Bitcoin, I save in dollars. And I think there's going to be a buying opportunity to buy in silver and gold here coming into the future." And now, he didn't ask me to elaborate on that, and that's pretty good because I really didn't have a good reason to explain it. All I had is that typically you would see interest rates rising as being a fearful thing of the future. And investors would see that interest rate rising and saying, "Okay, the fear of inflation is on its way. I'm going to put my money towards something that is going to protect me from inflation." And they would move it into gold, but that's not what's taken place. Gold prices are dropping as well. And now I'm reading an article saying that the gold prices are dropping because the higher yields on the bonds, somehow those higher yields are attractive to the gold investor. All of a sudden, the speculative investor is now looking at the higher interest rates on yields, thinking that they're going to be buying bonds to get the yield off of it. That's kind of a saver attitude, isn't it? To put your money and get a return on it. I just thought that was kind of weird to see this article come up, because typically I would think that the gold investor would be looking at the fear of inflation and be going into gold. Not looking at the fear of inflation going, "Oh, well, I better get out of gold too." But that's kind of what I saw taking place on the opposite end. As the speculative investor turned to bonds, gold rose with it, being a speculative asset of the fear of all the quantitative easing. But now the fear of inflation has the bond investor going, "I don't want to tie up my money." And the gold investor is right along with them. It's strange times indeed. I just don't I don't know what the future is going to be like. Nobody can predict it. But when I saw something illogically taking place, I had to logically think illogically again to come up with this. But it seems to be what's happening. And I have a feeling that if interest rates continue to rise into the future, that we're going to continue to see a drop in gold prices. Even though the fear of inflation is kicking in, the higher interest rates is going to stifle that inflation. I'm not worried about inflation. I'm not even worried about it. I've read a lot of Federal Reserve speeches, and they are not worried about inflation. If anything, they are worried about deflation. They're worried about deflation and the lower bound of zero. All this stuff is going to go away, and it's not even going to be talked about anymore once we go digital. Negative interest rates will be a common thing. People won't even people will talk about the times before negative interest rates, but they're not quite ready for it. They're working on it. I mean, you can see it in their words, you can see it in the actions, you can see it in China, you can see it all over the place. Everybody's getting ready to go digital. There is no doubt about it, but they are not ready yet. You know, I put my money towards three things: cash, silver, and Bitcoin. Those are the three. And I do cost price averaging. I buy a little bit all the time. And when you do that, your downside risk is very low. And, you know, your emotional connection is pretty much gone. Like, you don't have an emotional connection to like, oh my gosh, I got this fear that my investment's going to go to... You don't look at it like that. You know, and I mean, you think about this. I put $50 a week towards Bitcoin for the last 5 months. That little portfolio is up over $2,000. I've put in like less than $1,000. I think right around $1,000. Bitcoin can have a 50% retracement right now. It could fall 50% in price, and I would still be up on my money. Now, the upside potential was huge, but I wasn't looking for upside potential. I was looking for a little downside risk, and I found it in Bitcoin by doing a cost price averaging for the last 5 months during extreme volatility. Yes, I could profit a lot of money right now, but that's not what I am looking for. I am looking for little downside risk, and I found it there by doing this. I couldn't tell you what the Treasury General Account is going to do to the economy. I have a hard time believing that the Federal Reserve and the Treasury together are going to inject $370 billion a month into the system. I just don't think that's going to happen. Somebody is going to do something different, whether the Federal Reserve adjusts their quantitative easing, adjusts the banking system somehow. I just don't see $370 billion worth of liquidity injection every single month being a good thing for the economy. And I just don't see it happening. Now, if something doesn't change, that is what's going to happen, because the Treasury General Account has already, you know, I mean, Janet Yellen is already saying they're going to draw down on that account, and they're going to do it in a big way, and they're going to do it very fast. In my opinion, kind of fast, considering, you know, how much they say they're going to inject every month. Now, if I got it right, it was like the Fed is buying $120 billion worth of, you know, treasuries and mortgage-backed securities, and Janet Yellen's going to spend $250 billion out of the Treasury General Account every month. George Gammon did an excellent presentation on that in his last video, where he really breaks down where that money travels through and how it's going to circulate through the system. I mean, excellent piece. The only thing that I see about it is that I just don't think it's going to happen. I just don't think that $370 billion is going to make it into the system. Not in that fashion. You know, I mean, I could be wrong. I mean, I guess it could, but it's just like, to me, when I think about the people who are, you know, trying to control this system, that would be like, you know, just flying the plane right into the ground. It would be like purposely trying to pop asset bubbles. It'd be like, here, go ahead and just blow the housing market up and the market, you know, the stock market, and just go ahead and just do it. You know. So I don't see them doing that. I see something happening. I couldn't tell you what, but I would see them changing it so that that $370 billion does not enter the system in the idea that people are anticipating it will. I really feel that this is some sort of credible threat. But couldn't tell you what's going to happen from it. Okay, Uneducated Economist. You guys let me know.